Welcome back to the Dividend Diplomats YouTube channel, everyone. Lanny, Bert, the Dividend Diplomats, we are pumped up. We are talking to you about what could be an undervalued stock that has plummeted to start 2022.
Exactly. Now, Bert, before we do, this goes out to the millions and millions of dividend investors out there. We are here to talk, as Bert said, a stock that's on the downturn. But before we do, smash that subscribe button. Make sure you give the Diplomats a nice thumbs up. Turn it blue. Let's hit the views. Let's hit the thumbs up count. We're here for you to help you on your investing journey. Bert, what do we got in store today, baby?
Again, we have a stock that we are going to take a deep dive in to see if it's time to move some of our cash off the sidelines and into this company. But what's crazy is to start this short trading week off, we're recording this video on Tuesday, January 18th. The stock market took an interesting turn. Coming out of MLK Day, the stock market was down nearly 2%. The S&P 500 is below 4,600 once again. The news is interesting, Lanny, and it's getting me excited, and I know it's getting you excited because it might be time to start buying once again.
That's right. I mean, talk about a stock that you probably haven't bought for what, 3 or 4 plus years, Bert?
I grabbed this company. It went through some tough times several years ago, and that's when I loaded up on this company. So that's why it was exciting to see it potentially popping up once again, because it's been a long time since I've even had to think about them because they were trading at such a premium.
Yeah, it could have been maybe probably 4 years ago. So guys, we are heading into the, I don't know if you call it the beverage slash, nice service sector. I mean, Bert, what would you call this stock?
No, I think beverage and service is the right way to go because you could say that they are just simply a coffee shop, but they are so much more. And even during the pandemic, it took away one of the key pieces of the company. It was the atmosphere of the cafe and going there and sitting down. But lines are always long at this place. They're always wrapped around. If you do go into a store, the line's out the door. I never drive by this place and see an empty drive-through window.
No, 100%. We were talking about the one, the only Starbucks Corp, ticker symbol SBUX. I mean, guys, this stock, though it's up about 70% over the last 5 years, stock is down over 16% over the last, I guess year to date so far, hitting the new year. They're down about $19 per share. But you said it when we were talking earlier tonight. They're finally below $100 per share. It's almost like you could say, fine, Starbucks is back below 100.
Yeah. And that's what's exciting about it is whenever something clears that hurdle and that benchmark, of course, we're going to take a look at it, especially when it's been such a time before they went through that level and broke down. And I think what's interesting, though, is why some of the other reasons why we do want to consider it, too, is because when you take a quick look here at some of the financials and some of their dividend news over the last year, there are some great things that have your attention of like, oh, things are still going well here for Starbucks. I mean, their revenue's up over $5 billion from last year, or a 21% increase from there. Their dividend increase alone last year was 8.9%. So, things are still going well. They're still growing revenue. They're still growing earnings. They're still growing their dividend there. There's still some positive signs. So when you see the price go down, but you see the financials and the metrics going up, it's always worth investigating further to see if it's time to buy them.
And guys, before we look to see if it's a stock to buy, we obviously are focused on the 3 Dividend Diplomat stock screening metrics: the price to earnings ratio, the dividend payout ratio, the dividend growth rate, and lastly, we do lop in the big old lipper with the dividend yield.
Yep, and that is key. We run our dividend stock screener through every single one of our investment decisions. It's the entry screener. We'll look at other metrics once a company meets our stock screener. But if it doesn't pass or we're not comfortable with some of the metrics that are currently showing in the stock screener, forget about it.
Forget about it. Bert says if it doesn't pass, then it's just gas.
Is that what we say, Lanny? If so, I think that might look great on a coffee mug in our shop. We might have to draw that one up there.
Yeah. Tell me how your coffee smells in the morning. But guys, again,
Well, the
we're trying
coffee's going to smell great if you buy a Starbucks coffees from the shop and brew it at home. They also have that line too.
brew it up in a nice Dividend Diplomat coffee mug. Check out the spread shot below the
Does it?
video thumbnail. Bert, again, before we dive in, guys, we do bring up as many dividend stocks as we possibly can. There's so many on the list. We try to talk about the dividend stocks that are really, kind of hitting some different, I guess, stock prices right now during this, downturn in the stock market. And that's why Starbucks kind of was top of mind, even though there's so many that you, the viewers, have given us to talk about on upcoming videos. We're also trying to, plug in the ones that are, pretty much timely. We're trying to be in line and in sync with the market. No boy band reference there, but
yeah, no, I think that's important too. And I think you bring up a great point because a lot goes on in a day. There's a ton of stock news going on. So, I mean, sometimes we just need to look at the companies that are relevant and making the noise right now. And Starbucks, with a company that's down 16% year to date, they are making an awful lot of noise. So we have to address this one in addition to the long list of everything else.
And this is a great dividend growth stock. Keyword on growth. They're still in that very much not a tech type of company, but they are in a higher growth model. We'll talk briefly about the revenue year over year as well. And Bert, I know you're probably very excited to talk about that. I could see the drool coming out of your mouth from just the salivation of the excitement.
Yeah. So should we jump right in here to the stock screener, Lanny? I think.
Jump in.
Should we do it? All right. So metric number one, PE ratio, less than the S&P 500. Remember, everybody, closing price as of January 18th, Starbucks closed at 97.73. Forward earnings are $3.99. That gives you a PE ratio of 24.49. Compared to the market, that's slightly trading at a discount because the S&P 500 recently has been in the high 20s. But I think, Laney, you pulled in an interesting metric here for the analysis just to compare Starbucks to two other competitors in the industry to see how they stack up. Want to tell us here who you pulled the information for
Sure.
and how Starbucks is?
Obviously, again, Bert and I, we were just talking about it. Dunkin' went private back in the fall of 2020 during the pandemic with Arby's. So can't pull what their price to earnings ratio is. Thanks, Dunkin'. But let's dive into McDonald's. They have a price to earnings ratio trading at just over 25 at 25.3. And it's interesting, Yum Brands, which has their own kind of branded portfolio, is trading at about 25.53. So we're looking for a P ratio below that. And Bert, what was Starbucks again?
24.49. So they're trading at a slight undervaluation compared to their competitors in an even larger discount compared to the market. So interesting here. Obviously, the sector isn't the cheapest when you compare this one to other ones there, but it's great to at least see that if you're going to be looking for a coffee stock or a play on that, you're looking at Starbucks, who's trading at a discount.
I would agree. Seeing Starbucks below these two competitors is not that common.
Yeah, so that second metric here, let's roll right in the payout ratio. Again, we look for a payout ratio under 60%. A perfect payout ratio is between 40% and 60%. Starbucks annual dividend, $1.96. That payout ratio, when you divide that with forward earnings, is that perfect payout ratio of 49.12%. Fantastic.
I mean, right there in that sweet spot, Mr. Perfect. Kurt is so happy right now about seeing that perfect payout ratio. But with the perfect payout ratio, we'll have to look at that third dividend metric. Could that mean that it's lower dividend growth? Not so fast, because that third metric, again, that 5-year dividend growth rate on average from Starbucks is double digits at 16.9%. And they've been increasing it for 11 years. Now, I do want to point out that Starbucks might be slowing down in the growth area of their dividend, but it was just about 8.9% in that last dividend increase in 2021.
Yeah, I mean, it's hard for a long period of time to keep up in 16 to 18%, right? It's hard to keep up some extreme dividend growth. Although if earnings grow by a similar percentage point, you can, in theory, keep up a correlatingly strong increase. Starbucks is talking about expanding globally. That's been their focus recently. Obviously, it's going to take some cash. It's going to take some capital. So you can understand how you might slow down during a pandemic. It'll be interesting to see what they do in 2022 here, if they're going to regain some of that double-digit dividend growth there. So moving into that last bonus metric, the dividend yield. This one's fascinating, Lanny. Why? Because with a 16% drop in the stock price year to date, Starbucks is finally back over the 2% dividend yield threshold. Their dividend yield is 2.01%. Don't forget that extra basis point. That is important. That is critical right there.
Every basis point counts in the name of this game here. So we'll take
I think that could be a coffee mug too.
Yeah, us dividend nerds over here. Again, one thing to note, revenue from Starbucks. Revenue is up 5 billion compared to prior year. They're up 21% right now. Obviously 2020 not the greatest year to compare, but they were up 5 billion, 21% top line growth. I mean, that's pretty impressive. Will they hit 21% going into 2022? Probably not, but again, but yeah, it could happen. I mean, I'm not going to say that they can't do it. I know I've had a few Starbucks incidents where, as I drive on my commute to work, I have seen Starbucks lines either really long or I've seen none because they've shut down their offices in case there's been some COVID scares, that they're pretty big on closing down at what it looks like, or when there's staff shortages. So I think once we come back out of this pandemic, which I don't know how long we can keep saying that I don't think we've seen the best of Starbucks yet.
Yeah, I think that's fair. I think a lot of companies fall into that bucket too, but at least I can tell you for the majority of this pandemic, you can still see they've mastered the drive-through. They've mastered getting people in and out there quickly. So everyone's going to have their experience. That's the important thing, and that's how you're able to grow your revenue 21% year over year.
Bert, I know you're walking in there just grabbing whatever coffees to go. You're just picking up somebody else's online order all the time.
Yeah, and what I'm doing is I'm taking my app and I'm just like sneaking in there right before they pay and just scanning it myself so I get the rewards. But all right, let's summarize here. PE ratio 24.49, payout ratio 49%, 5-year dividend growth rate 16.88%. They've increased that dividend for 11 years, and that dividend yield is over 2%. So Lanny, what are you thinking here? Starbucks, is it earned a spot on your watch list, or are you even going to go out and buy some this week? What do you think?
So, in my portfolio, I'm kind of looking at it right now. Again, link below in the comments to our dividend portfolio. I only own 26 shares in my individual account. My wife, we actually do own, she definitely loves Starbucks, but in total, we own over 100 shares for her. Mm-hmm. So we do have a pretty strong position of Starbucks. I'm like, we love our coffee. No, we do love coffee, but again, we think Starbucks is a great brand, great service, just a great atmosphere that they provide to the customer. They are on my watch list though. To answer your question, Bert, they are on my watch list. Given my entry points and how many shares we have, I may be just on a hold. But definitely am watching that stock price.
Yeah, I think that's a fair conclusion here. We have about 85 shares of Starbucks combined, so we have a large position too. It's definitely going to earn a spot on the watch list. How could it not at below 100 shares again? But that too, there are also plenty of other stocks that we are going to keep an eye on as well. Am I running to buy Starbucks tomorrow? No, but you bet if it keeps dropping and it keeps sliding to start the year, we might round that position out to 100, but we'll have to see what exactly is going on here with Starbucks.
So guys, I think you just need to keep buying Starbucks coffees right now so you can increase their revenue and their bottom line for us shareholders.
Yeah, I think that's the answer. So let us know what you think about Starbucks. Are you buying coffee today? That's the important thing here. And if you haven't already, everybody, subscribe to our channel. Give us that thumbs up. Again, thank you for watching. Thank you for supporting us over the last couple of years here on the old YouTube channel. And then let us know what other stocks you want us to analyze.
That was Bertha Hurt and Lanny from the Dividend Diplomats. Over and out.